If you had asked most investors 5 years ago which gym chain would emerge stronger after COVID, Planet Fitness probably would not have been the first answer. After all, gyms were one of the hardest hit industries in America. Locations were forced to close. Members froze subscriptions. Fitness habits changed overnight. Consumers built home gyms. Peloton became a Wall Street darling. Investors began questioning whether traditional fitness centers would ever fully recover. Then the bankruptcies started. 24 Hour Fitness filed Chapter 11. Gold's Gym filed Chapter 11. Town Sports International, the parent company of New York sports clubs, filed for bankruptcy. Countless independent operators disappeared entirely. If there was ever an industry that looked vulnerable, it was fitness. And yet, here we are. Investors are willing to pay nearly $8.7 million for this Planet Fitness in Northridge, California at a 5.5% cap rate. The company operates more than 2,900 locations, continues opening hundreds of new stores, and has become the largest gym operator in the United States. That immediately caught my attention, and this cap rate tells a very interesting story. It tells me the market believes Planet Fitness didn't just survive the industry's worst crisis, it believes Planet Fitness emerged stronger because of it. One of the things I've learned over the years is that the glossy brochure is designed to direct your attention towards the things that make you feel comfortable. The long lease, the rent increases, the demographics, the traffic counts, the recent capital improvements, the bright photographs, and the cap rate. What the brochure rarely does is force you to ask the harder questions. Why did Planet Fitness survive while so many competitors struggled? What makes this business model different? And why are investors willing to accept a 5.5% cap rate for a gym when the entire industry looked broken just a few years ago? Welcome back to the Commercial Real Estate Deal Room. I'm Mercedes Shaffer, commercial real estate broker, business broker, and the agent who goes beyond the glossy brochure to help investors understand what they're actually buying. Because when I evaluate an investment opportunity, I'm not just looking at the lease and the location, I'm evaluating the business behind the real estate. And in this particular deal, I think the business story is far more important than the building itself. The biggest misconception about Planet Fitness is that people think it's competing against other gyms, and I don't think it is. I think Planet Fitness is competing against doing nothing. So what do I mean by that? I know that might sound strange, but I believe that's exactly why the company has been so successful. Historically, the fitness industry focused on people who already liked going to the gym. Bodybuilders, serious athletes, fitness enthusiasts, people who understood equipment, training programs, nutrition plans, and gym culture. Planet Fitness looked at the market differently. They realized there were millions of people who wanted to get healthier but felt intimidated walking into a traditional gym. Some felt out of shape, others didn't know where to start, many worried they wouldn't fit in. Planet Fitness recognized that beneath all those concerns was a simple but powerful fear: being judged. Most gym operators tried to attract the most committed fitness consumers. Planet Fitness focused on everyone else. The judgment-free zone wasn't just a clever slogan, it was a business strategy. The company identified one of the biggest barriers preventing people from joining a gym and built an entire brand around removing that barrier. Then they paired it with a membership price that felt almost impossible to say no to. For many consumers, $15 a month feels insignificant. In fact, many members spend more thinking about canceling than they spend paying for the membership itself. That's a remarkably powerful model. What I find fascinating is that Planet Fitness succeeded by solving a different problem than most gyms. Many fitness brands focused on performance, specialized training, or premium experiences. Planet Fitness focused on making exercise feel approachable. While other operators were selling fitness, Planet Fitness was removing the barriers that kept people from walking through the front door in the first place. This is the type of due diligence I do for my clients when helping them assess an investment property. Because at the end of the day, that's what determines whether the rent keeps getting paid. And if you're evaluating a triple net investment and you'd like a free copy of my cap rate analysis system or would like help evaluating investment opportunities like this, you'll find a link to my contact information in the description below. Now, to really understand this investment, you have to understand what happened to the rest of the industry. When COVID hit, gym operators faced a perfect storm. Membership revenue disappeared. Fixed costs remained. Rent remained. Payroll remained. Debt remained. Many operators had built business models dependent on premium memberships, personal training revenue, group classes, juice bars, and ancillary services. When those revenue streams disappeared, the financial stress became overwhelming. And what happened is 24-Hour Fitness ultimately filed bankruptcy and closed locations. Gold's Gym filed bankruptcy and sold assets. Town Sports International collapsed, and many regional operators never reopened. Even after restrictions ended, consumers had alternatives. Peloton convinced people they could work out at home. Mirror promised an entire gym experience through a screen. Tonal offered strength training without leaving the house. Investors began questioning whether traditional gyms would ever regain their relevance. But Planet Fitness was different because Planet Fitness wasn't dependent on a small group of highly engaged members spending large amounts of money. Its business model was built around affordability and scale. While competitors were trying to protect premium pricing, Planet Fitness continued attracting budget-conscious consumers. While others were shrinking, Planet Fitness continued expanding. And when weaker competitors disappeared, Planet Fitness had the opportunity to capture market share. This is one of the reasons I think investors continue rewarding the company with relatively aggressive pricing. The market isn't valuing Planet Fitness based on where the industry was 5 years ago. The market is valuing Planet Fitness based on who survived. Now let's talk about why this particular location became even more interesting, because this isn't a Planet Fitness in rural America. This is Southern California. If there's one place where health, wellness, appearance, and fitness are deeply embedded into the culture, it's Los Angeles. Fitness isn't simply a hobby here. For many people, it's part of their identity. Consumers spend money on wellness, nutrition, appearance, longevity, and personal performance in ways that simply don't occur in many other parts of the country. And this specific location benefits from several factors that strengthen that story. The property sits near Cal State Northridge with approximately 38,000 students and 4,000 employees. Major employers include Amazon, Northrop Grumman, and Anheuser-Busch, all located nearby. The surrounding population exceeds 280,000 residents within 5 miles, and average household incomes exceed $140,000 within a 1-mile radius. These are exactly the type of demographics fitness operators want to serve. What I also find interesting is that Planet Fitness doesn't need every consumer in this market. It simply needs a relatively small percentage of a very large population base. That's the beauty of the model. When you combine low pricing, broad appeal, and dense demographics, the economics become very attractive. This isn't a gym hoping people show up. This is a gym operating in one of the most fitness-conscious consumer markets in America. One of the things I also like about this deal is the lease structure itself. It has a 15-year triple net lease with approximately 15% rent growth scheduled over the next 6 years. In a world where many triple net investments offer little to no rent growth, that's meaningful. Investors aren't simply buying today's income stream, they're buying an income stream that is contractually expected to increase. That matters because inflation never stops, and rent growth helps protect purchasing power over time. There's also been recent capital expenditures, including a new roof and HVAC system. I like to pay attention to things like that because tenants generally don't invest significant capital into locations they intend to abandon. Those improvements suggest the tenant remains committed to the site and believes in long-term viability of the location. Combined with a long lease term and true triple net structure, it creates exactly the type of passive investment many 1031 exchange investors are seeking. And one of the things I've learned working with investors is that not everyone is chasing the highest return. Many investors already built their wealth through apartments, development projects, business ownership, value add opportunities, or active management. At some point, the question shifts from maximizing returns to preserving wealth. That's why many investors are willing to accept a lower cap rate in exchange for a long lease, contractual rent growth, and fewer headaches. And the more I studied this investment, the more I realized the 5.5% cap rate isn't really about the building itself. Yes, the location, the lease, the demographics, rent increases, and real estate fundamentals all matter and play an important role, but ultimately, investors are making a bet on the business that will be paying the rent for the next 20 years. What they're really buying is confidence in the Planet Fitness brand and the business model behind it. Planet Fitness identified a massive underserved segment of the fitness market and built an entire company around serving those customers. Over time, it scaled that model across thousands of locations and established itself as one of the most recognized brands in the industry. Investors see a company that has demonstrated resilience through changing economic cycles, shifting consumer behavior, and intense competition. They see a brand that continues to attract members, expand its footprint, and maintain a strong position within the fitness landscape. The real estate provides the income stream, but the quality of that income stream depends on the strength of the tenant. In this case, investors aren't simply evaluating a lease agreement, they're evaluating the long-term durability of the company signing the checks. And that's really what this investment comes down to: durability. The durability of the brand, the business model, and the consumer demand for affordable fitness, and the durability of the tenant's ability to continue generating revenue and paying rent year after year. That confidence is what allows this property to trade at a lower cap rate and a higher valuation than many other retail investments. The market is placing a premium on the belief that Planet Fitness will remain relevant, continue attracting members, and continue occupying this location well into the future. Whether that premium is justified is ultimately for each investor to decide. But understanding that you're investing in both the real estate and the strength of the business behind the lease is critical before deciding whether this opportunity belongs in your portfolio. So what do I think? I think this is one of the more interesting triple net investments I've reviewed recently because the business story is actually stronger than the real estate story. Most investors see treadmills, ellipticals, and exercise equipment. I see a company that figured out something many competitors missed. Planet Fitness realized that the biggest opportunity wasn't convincing serious gym users to switch gyms. The biggest opportunity was convincing millions of people who never joined a gym in the first place. That's a much larger market. The company survived one of the worst crises the fitness industry has ever faced, while many competitors filed bankruptcy. It continues opening locations, it continues growing, and it continues benefiting from a business model that appears remarkably resilient. Now, does that mean a 5.5% cap rate is a good deal? Not necessarily, but I understand why investors are willing to pay it. At the end of the day, investors aren't paying for treadmills. They're paying for a business model, and that business model may be one of the strongest in the entire fitness industry. And whether you're evaluating a triple net investment, considering a 1031 exchange, or simply trying to become a more informed commercial real estate investor, I hope you found this analysis helps you look beyond the cap rate and better understand what you're actually buying. If you'd like a free copy of my cap rate analysis system or would like help evaluating investment opportunities like this, you'll find a link to my contact information in the description below. I'm Mercedes Shaffer. This is the Commercial Real Estate Deal Room, and I'll see you in the next deal.